Silver didn't crash because of supply and demand. It crashed because the system needed it to. That statement sounds extreme until you look at the timing, the mechanisms, and the beneficiaries, because every major silver collapse arrives the same way, not slowly, not randomly, but suddenly, violently, and always when public interest is rising. Always when confidence in paper money is weakening. Always when silver starts behaving like what it really is, not a commodity but a monetary warning signal. Most people believe silver crashes for the same reason any asset crashes: too much speculation. Too much excitement, too many retail investors chasing gains. That's the story you've heard. That's the story financial media repeats every time, and that story feels comfortable because it makes the system look fair. It suggests mistakes were made, lessons were learned, and the market corrected itself. But this is not what they teach you. Silver does not trade like a free market asset. It trades like a controlled pressure valve inside the global monetary system. To understand that, you first have to unlearn what you think you know. When silver prices rise, the official explanation is simple: increased demand, inflation fears, speculative excess. But when silver prices collapse sometimes by 30 or 40% in weeks, the explanation suddenly changes. Now it's risk-off sentiment, margin calls, technical breakdowns. The same market, two different stories. Here's the contradiction. In a real free market, rising demand raises prices, falling demand lowers prices. But silver crashes almost always happen during periods of high demand, not low demand, during inflation scares, during currency crises, during moments when trust in the financial system is already fragile. That alone should raise questions. Take 2011, silver surged to nearly $50 an ounce. Retail investors were buying coins and bars faster than mints could supply them. Dealers reported shortages, premiums exploded, physical demand was overwhelming, and then almost overnight the price collapsed. What changed? Not demand, not supply, not industrial usage. What changed were rules. Margins were raised repeatedly within days. Futures contracts suddenly required far more cash to hold. Liquidity vanished, forced selling began, and the media narrative flipped instantly. Silver wasn't protection anymore, it was a bubble. It wasn't money, it was a gamble. The public was blamed for believing in it. This pattern is not unique. It repeats across decades because silver is different from gold in one critical way. Gold is treated as a reserve asset. Silver is treated as a threat. Gold sits in vaults. Silver moves through the real economy. It is money, but also infrastructure. Electronics, solar panels, medicine, military technology. If silver is honestly repriced, it exposes inflation in a way central banks cannot control. And that is why silver is more dangerous than gold. Historically, silver was money for ordinary people. Gold was money for kings. Empires could hoard gold, but silver circulated. It revealed debasement faster. When governments clipped coins, reduced purity, or overissued currency, silver disappeared from circulation first. That wasn't accidental. It was a signal. Fast forward to the modern era and the same dynamic exists, just hidden behind complexity. Today, most silver trading does not involve physical metal at all. It involves paper claims, futures, options, derivatives, contracts promising delivery that almost never happens. On paper, more silver is sold every day than physically exists above ground. That alone should be impossible in a free market. This is not what they teach you. Paper silver exists to control the price of physical silver. When you buy a silver futures contract, you're not buying silver. You're buying exposure to a price. That distinction matters because exposure can be created infinitely. Physical metal cannot. This is where the system gains leverage. By allowing unlimited paper silver creation, large institutions can sell silver they don't own. This is called a short position. In most markets, excessive shorting would be constrained by supply. In silver, it isn't because settlement almost never requires delivery. A handful of major banks hold disproportionately large short positions in silver. This has been documented repeatedly, not alleged, documented. Year after year, regulators publish reports showing extreme concentration, and year after year, nothing changes. Why? Because these banks are not acting alone. They are acting within a system that depends on silver staying quiet. If silver were allowed to reflect real monetary conditions, debt expansion, currency dilution, loss of purchasing power, it would compete directly with fiat money. It would signal weakness. It would break confidence. And confidence is the foundation of modern currency. That's the moral contradiction. Governments claim silver is irrelevant. Central banks say it's just another commodity, but their actions say something else entirely. If silver didn't matter, it wouldn't be so carefully controlled. Look at how crashes are triggered. They don't begin with bad news. They begin with rule changes. Margin hikes announced after hours, sudden increases in collateral requirements, liquidity withdrawn precisely when buying pressure is strongest, then the media follows, headlines shift tone within hours, silver frenzy ends, speculators burned, market returns to sanity. The story is already written, the crash just provides the footage. This isn't coincidence, it's choreography, and it has precedent. In 1980, the Hunt brothers were blamed for manipulating silver. That's the version most people know. Two wealthy Texans cornered the market, drove prices too high, and deserved what they got. That's the lesson taught. But here's what's not taught. Rule changes were implemented specifically to stop buying while allowing selling. Liquidation only, a phrase that should never exist in a free market. Prices collapsed not because the market corrected, but because it was forced. Victory for stability, loss for price discovery. The system survived. Silver was neutralized, the lesson was set. Every crash since has followed the same structure. Silver rises, public interest grows, confidence in currency weakens, then pressure release, controlled collapse, blame assigned, order restored. This is why silver is allowed to rise, but never too far. It acts as a warning light. When it flashes too brightly, it must be dimmed. And this leads to the real question. Not whether silver crashes are manipulated, but why? Because manipulation without motive makes no sense. Silver exposes the lie at the heart of modern finance, that money is stable, neutral, and apolitical. Silver reminds people that money is created, that debt expands, that purchasing power falls, that promises exceed reality, and systems built on belief cannot afford reminders. By the end of this story, you'll understand why silver collapses don't arrive randomly. They arrive on schedule, because silver doesn't fail. The system does. To understand why silver collapses always look engineered, you have to understand who actually controls its price and who does not. Most people assume prices are set by millions of buyers and sellers acting independently. That belief feels democratic, it feels fair. But in silver, price discovery does not happen where physical metal changes hands. It happens in paper markets, on futures exchanges, in derivatives books, inside balance sheets the public never sees. This is not what they teach you. In the modern silver market, the vast majority of trading volume occurs in contracts that promise silver at a future date. These contracts can be created almost without limit. There is no natural scarcity constraint because the metal does not need to exist at the moment the contract is written. This allows large players to sell massive quantities of silver they do not own, suppressing price without ever touching a single ounce. In any other market, this would collapse under its own weight. If too many claims exist on a scarce resource, delivery failure would expose the fraud. But silver avoids that outcome because nearly all contracts are settled in cash. Not metal, cash. That distinction changes everything. When delivery is optional, price becomes narrative-driven, not supply-driven. It becomes psychological. It becomes manageable. And that is where banks enter the story. A small number of financial institutions have consistently held outsized short positions in silver for decades. This is not speculation. It is recorded. Regulatory data shows extreme concentration levels that would trigger investigations in any genuinely competitive market. Yet enforcement never arrives. Instead, what arrives are fines, quiet settlements. No admission of wrongdoing, no structural change, a cost of doing business. That tells you something important. If these positions threaten the system, they would not be allowed. If they harmed only private investors, they would be prosecuted. The fact that they persist tells you they serve a purpose. That purpose is price control. Banks act as intermediaries between the silver market and the monetary system. When silver rises too quickly, short positions expand, paper supply increases, price pressure is relieved. When silver must fall, liquidity is withdrawn, margins rise, forced selling begins. And the public is told it's natural. This creates a recurring illusion: volatility without accountability, crashes without causes, lessons without reform. Look closely at the triggers and the pattern becomes impossible to ignore. Silver crashes are never gradual, they are sharp, sudden, clustered, multiple margin hikes within days. Rule changes announced after market close. Liquidity disappearing exactly when buyers are most active. These are not organic market responses. These are mechanical interventions, and they almost always occur during moments of broader monetary stress. Inflation fears, currency debasement, debt expansion, financial instability. When people start looking for alternatives to paper money, silver rises. When too many people notice, it must be stopped. That's why silver crashes happen during high demand, not low demand. This is the part that breaks the official story. In 2008, during the global financial crisis, silver initially collapsed alongside everything else. That makes sense. Liquidity vanished everywhere. But what happened next is more revealing. Physical demand surged. Mints ran out of supply, premiums disconnected from spot price. The paper price said silver was cheap. The physical market said silver was scarce. That divergence has never fully closed. Because it can't, paper silver can be expanded infinitely, physical silver cannot, and every time the gap widens, the system becomes more fragile. This is why total suppression is impossible. If silver were held down permanently, it would expose the mechanism. People would notice shortages, delivery failures, price distortions too obvious to ignore. So instead, silver is allowed to rise briefly, just enough to maintain the illusion of a free market, just enough to release pressure, then it is crushed. This is controlled volatility, and it benefits specific players every single time. Banks close short positions at lower prices. Governments protect the credibility of their currencies. Industrial buyers secure cheap supply. And retail investors who arrive late, driven by headlines and fear, absorb the losses. That's the moral contradiction. Silver is framed as dangerous when it rises, but its collapse always saves someone powerful. If silver were truly irrelevant, no one would care. If it were just another metal, no one would intervene. But silver is not just metal, it is a mirror. It reflects confidence or the lack of it, and that brings us to the role of media. Media narratives do not react to silver crashes, they prepare for them. Language patterns repeat with uncanny consistency. Speculative excess, mania, unsustainable rally. These phrases appear before the collapse, not after. They condition the audience, they preassign blame. When the crash arrives, the story is already written. Notice when silver is called money and when it is not. When prices are flat or falling, silver is dismissed as a barbarous relic. When prices rise, it suddenly becomes a risky trade. Rarely is it discussed as what it has been for thousands of years, a monetary metal outside political control. That framing is not accidental. Because once people understand silver's role historically, modern policy becomes harder to justify. This is not what they teach you. Silver was removed from monetary systems not because it failed, but because it worked too well. It constrained debt, it limited expansion, it forced discipline. Fiat currency requires flexibility. Deficits, credit growth, monetary expansion, silver exposes all three. And so the system neutralized it not by banning it but by financializing it. Paper silver replaced metal silver, price replaced possession, exposure replaced ownership, and crashes replaced confiscation. By now, the question should be forming naturally: if silver crashes are engineered, if paper supply exceeds physical reality. If a handful of institutions dominate price movement, if regulators tolerate extreme concentration, if media narratives align perfectly with mechanical triggers, then silver's behavior is not an accident, it is a function. And the function is simple: protect confidence. Because confidence, not gold, not silver, not productivity, is the true reserve asset of modern economies. Break confidence and everything else follows. Silver doesn't just threaten inflation narratives, it threatens belief itself. That is why it is allowed to rise but never to settle, allowed to signal but never to speak, allowed to warn but never to accuse. And that is why its crashes always look the same. In the next part, we will examine historical silver collapses more closely, not as isolated events, but as repetitions of the same template across decades. You'll see how the Hunt brothers' story was simplified, how 2011 followed the same playbook, and how recent stress in paper markets hints at something the system can no longer fully control. Because the question is no longer whether silver crashes are engineered. The question is how long the system can keep doing it. To see the pattern clearly, you have to stop looking at silver crashes as isolated events and start looking at them as repetitions of the same design. History doesn't hide this, it repeats it. In 1980, silver reached nearly $50 an ounce. Adjusted for inflation, that would be well over $150 today. The official story is simple and convenient. Two wealthy brothers, the Hunts, attempted to corner the silver market. They caused an artificial price spike. Regulators stepped in to restore order. Justice was served. That story ends the conversation before it begins. What's missing is timing, method, and motive. When silver prices surged in late 1979, it wasn't just the Hunts buying. Inflation in the United States had crossed 13%. Confidence in the dollar was collapsing. Gold was rising. Oil prices were exploding. People were running from paper assets into hard ones. Silver wasn't leading the panic. It was reflecting it. Then came the rule changes. On January 7, 1980, the COMEX imposed liquidation-only trading on silver futures. No new long positions were allowed, buying was restricted, selling was not, margin requirements were raised aggressively, liquidity vanished. This was not a neutral market response. This was a one-sided intervention. Prices collapsed. The Hunts were destroyed, but more importantly, silver was neutralized. The message was clear: monetary metals would not be allowed to expose systemic weakness. This is not what they teach you. Fast forward to 2011. Once again, silver approached $50 an ounce. Once again, the backdrop was monetary instability. The Federal Reserve had launched multiple rounds of quantitative easing after the 2008 crisis. Trillions of dollars were created electronically. Interest rates were pinned near zero, savers were punished. Debt exploded, silver responded, retail investors poured in, coin shops emptied, the U.S. Mint suspended sales multiple times due to shortages. Premiums surged far above spot price. The physical market was screaming scarcity. Then came the same sequence. Between April 25 and May 5, 2011, the CME raised margin requirements on silver futures 5 times in 9 days. 5, that is unprecedented. Each increase forced leveraged players to post more cash or sell. Forced selling drove prices down. Falling prices triggered more margin calls. A cascade followed. The media narrative flipped instantly. Silver was no longer protection. It was speculation. It was mania. It was irresponsible. Within weeks, silver had lost over 30% of its value. What changed fundamentally during those 9 days? Not inflation, not debt, not monetary policy, not physical demand, only rules. And yet, once again, the collapse was framed as natural. Then came 2020. During the COVID crisis, global markets froze. Oil went negative, supply chains fractured. Governments printed money at a scale never seen before, trillions in stimulus, direct payments, debt without limit. Silver initially collapsed with everything else. But physical demand returned almost immediately. Mints ran out of blanks, dealers quoted months-long delays, premiums exploded. The spot price said silver was cheap. The real world said it wasn't available. That divergence became impossible to ignore. At one point, exchange-traded funds reported record silver inflows while physical availability tightened. Paper claims multiplied, delivery expectations quietly weakened, settlement remained cash-based. Once again, the system absorbed stress by expanding paper promises instead of repricing metal. The crash was delayed, not prevented, because every cycle pushes the system closer to its limit. This is the part rarely discussed. The silver market functions on trust, trust that paper claims can always be settled. Trust that delivery won't be demanded en masse. Trust that price suppression will not trigger exposure, but trust erodes. Every time physical demand overwhelms supply, every time premiums disconnect from spot, every time mints suspend sales, the illusion weakens. That's why crashes are necessary. Crashes reset behavior. They discourage participation. They reinforce fear. They teach retail investors a lesson. Don't touch this market. It's dangerous. It's manipulated. You'll lose. And most do. This creates a self-reinforcing cycle. Silver rises, right arrow attention grows, right arrow participation increases, system stress rises, right arrow intervention occurs. Intervention causes crash drives people away, order restored. Until the next cycle. This is not accidental behavior, it is regulatory psychology, and it explains why fines change nothing. Major banks have paid hundreds of millions of dollars in penalties related to precious metals trading, spoofing, manipulation, false orders. Yet positions remain concentrated, structures remain intact. The behavior continues, because the goal is not to eliminate manipulation, the goal is to manage outcomes. Here's the deeper contradiction. Governments claim silver has no monetary role. Central banks hold gold but not silver, yet silver remains critical to industry, defense, and infrastructure. It is consumed, not hoarded. Above-ground stockpiles shrink. Unlike gold, silver is used up. This makes honest price discovery even more dangerous. If silver were priced honestly, it would reveal two things simultaneously: monetary debasement and resource scarcity. That combination is explosive. So the system suppresses the signal not by banning silver but by burying it under derivatives. Paper silver is not designed to deliver metal. It is designed to absorb demand. And when demand exceeds absorption capacity, the system panics. That panic is what you see as a crash. This reframes the entire story. Silver crashes are not failures of silver. They are stress fractures in the monetary system. They occur when reality presses too hard against illusion. And that brings us to the present. Today, global debt is higher than ever. Interest rates are rising. Governments face unsustainable obligations. Currency confidence is fragile. People are once again asking uncomfortable questions about money. Silver is responding, not explosively, not yet, but directionally. The system still has tools, liquidity, regulation, narrative, but each cycle requires more force, more intervention, more distortion. And distortion accumulates consequences. At some point, the pressure release valve fails, not because silver wins, but because belief breaks. In the final part, we'll confront the real implication of all this. What silver's behavior tells us about the future of fiat currencies, why permanent suppression is impossible. And why the most important question is when silver will rise, but what happens when it no longer crashes on schedule? Because when that happens, it won't be a silver story. It will be a monetary one. At this point, the story of silver is no longer about metal. It's about belief. Modern monetary systems do not collapse because resources disappear. They collapse because confidence does. Currency works only as long as people trust that tomorrow it will buy roughly what it buys today. Once that trust weakens, money stops functioning as money and becomes just paper with a promise attached. Silver interferes with that promise, not loudly, not dramatically, quietly, persistently. Every time silver rises, it reminds people subconsciously that value can exist outside government decree. That money once had weight, that limits once existed. That debt once had consequences. This is why silver cannot be allowed to reprice permanently. A sustained silver repricing would do something far more dangerous than raise jewelry costs or industrial inputs. It would force uncomfortable questions. Why is silver rising while wages stagnate? Why does purchasing power fall while asset prices soar? Why do savings lose value even when productivity increases? Those questions lead to conclusions policymakers cannot afford. So silver is managed, allowed to signal, but never to settle. This is not what they teach you. If silver were honestly priced based on scarcity, consumption, and monetary dilution, it would not trade where it does today. Silver is consumed every year. Much of it is unrecoverable. Above-ground reserves shrink while paper claims expand. That imbalance alone demands repricing. But repricing would expose the deeper imbalance between promises and reality. So the system chooses volatility over truth. Volatility distracts. Volatility confuses. Volatility discourages participation. It convinces people that silver is unpredictable, dangerous, and unsuitable as money. That is its real function, and it works most of the time. Retail investors who experience one silver crash rarely return. Institutions learn the rules. Media reinforces the lesson. Stability is restored until the next cycle, because cycles cannot be eliminated, only postponed. The longer suppression continues, the more extreme the eventual adjustment becomes. Not because of silver, but because of everything else expanding around it. Debt grows, obligations compound, interest costs rise, confidence thins. At some point, the system faces a choice: allow repricing or lose control. History shows how that choice ends. Every fiat system eventually reaches the same moment. The point where confidence requires intervention. Intervention requires distortion. Distortion requires force, and force accelerates collapse. Silver sits quietly inside that sequence, not as the cause but as the indicator. This is why silver crashes always arrive on schedule. They are not reactions, they are preemptions. They occur before confidence breaks, not after, and that leads to the most important distinction of all. Silver has never failed as money. Every currency that replaced it eventually did. The Roman denarius lost silver content until it became copper. The British pound was once a pound of silver. The US dollar was defined by silver and gold until it was. Each transition followed the same logic: remove the constraint, expand the supply, manage the narrative, short-term relief. Long-term decay. Silver didn't disappear because it was obsolete. It disappeared because it was inconvenient. It imposed discipline. It limited extraction. It made promises expensive. And that's the moral contradiction at the center of the modern system. Governments claim to protect stability while undermining the very mechanisms that create it. They frame silver as risky while managing currencies that lose value by design. They warn against volatility while engineering it. Victory is presented as control. Loss is disguised as progress. This is not what they teach you. The future of silver, then, is not about price targets or timelines. It's about inevitability. The system can continue suppressing silver as long as paper claims are trusted and physical delivery is avoided. As long as most people prefer exposure over ownership. As long as confidence holds. But confidence is not infinite. When people stop asking how much silver costs and start asking whether it's available, the game changes. When delivery matters more than price, the paper market loses relevance. When belief breaks, control breaks with it. That moment does not announce itself. It arrives quietly. Premiums rise, delays extend, contracts settle in cash, explanations grow thinner, and then one cycle fails to reset. That is the scenario the system fears, not a silver rally but a silver that doesn't crash on command. Because when silver stops collapsing on schedule, it will mean the pressure valve is jammed. And when pressure can't be released, it finds another outlet. Currency confidence, debt markets, political stability. Silver will not cause that shift, it will only reveal it. So the real question is not whether silver is manipulated. The evidence is already there. The real question is why something dismissed as irrelevant must be controlled so carefully. If silver is just a metal. Why does it require rule changes? Why does it trigger coordinated narratives? Why does it attract concentrated intervention? And why does its collapse always protect the same interests? Silver didn't fail. The monetary system did. And every time silver crashes, it's not a market event. It's a message.